The UK economy grew at twice its predicted pace in the month of May. Welcome to Market Insight, I'm Ramzan Karamali. So GDP grew at 0.4%, much more than predicted. So what does this mean for the wider economy and for policymakers at the Bank of England? Well, to help answer that, I'm joined by Daniel McCormack, Head of Research at Macquarie Bank. Daniel, thanks so much for joining us. Well, let's start on those GDP numbers. What do you make of those numbers, and what does this mean for the overall economy going forward?
This is another better than expected set of GDP numbers for the UK economy, and it's really clear, I think, that after experiencing the mildest of mild recessions in the second half of last year, the UK economy has recovered really quite robustly in the first half of this year. Does it have any implications for the Bank of England, or what implications does it have? I think not a lot. Monetary policy is clearly in restrictive territory, and what they'll be looking for to reduce the rate of restriction or the degree of restriction is inflation. And inflation so far has been really quite benign. And if that continues, I think the Bank of England will move to ease rates, and potentially starting in August.
But isn't there a worry, though, that with really robust growth, there's no need to cut rates, that actually the economy doesn't need a helping hand here?
I think it's clear that the UK economy has weathered the higher rates much better than most people would have anticipated. But if you can have non-restrictive monetary policy, you should. It's good for growth, it's good for living standards, and if the inflation data allow it, the Bank of England will move in that direction. And actually, I think, given how restrictive policy is, actually, the Bank of England could end up cutting quite a bit faster than the forward curve suggests. So I would be a buyer of UK gilts.
So are you quite surprised by the market reaction? The chance now of a rate cut in August is down to sort of 50%. Shouldn't it be much higher than that?
I think it should probably be higher, although there have been some hawkish noises coming out of the Bank of England recently. So markets tend to focus, very intensely on the next meeting or the next couple of meetings. I think it's more instructive to look at the full length of the forward curve, perhaps over the next 12 or 18 months, and try and make a judgment about, is that too shallow? Or is it too steep? And I think it's too steep, as in rate cuts could proceed more aggressively than that. I mean, if the inflation data continue to do what they did in the first half of the year, I think we'll almost certainly see faster rate cuts than the market is expecting. I'd expect that they would kick off in August, but even if they don't, over the more medium term, I think you'll get more rate cuts.
Now, turning to Germany, they just confirmed CPI data for June at 2.2%. What does that actually mean for policymakers of the ECB? They've already started their easing programme. Do you think there'll be more to come then?
I think there will be more to come. I don't think today's inflation numbers are a huge surprise or really change their calculus in any material way. The ECB has started its easing cycle, and I suspect there is more to come. The market's priced about 125 basis cut every second meeting, so every 3 months. And I broadly think that is right. I mean, the ECB will proceed cautiously on this. They don't need to rush it. So, I would be kind of neutral on European bonds, generally speaking.
And we've just had pretty soft inflation data out of the US, the 12-month rate at about 3%. What do you make of that?
Very benign numbers. So the core month-on-month was 0.1%, the headline minus 0.1%, both weaker than expected, and come on the back of a very benign report last month. So overall, the inflation data have really complicated the Fed's messaging, I would say, this year. They came into 2024 with a dovish message. We then had some high inflation numbers. They then switched to a bit more hawkish rhetoric. Now we've had dovish inflation numbers, but I think the dovish inflation numbers, benign inflation numbers, combined with just some emerging concerns about growth in the labour market, means that the Fed will probably move towards easing fairly quickly now, would be my guess. And I think a rate cut in September is a really good chance.
Now, we heard from Powell over the last couple of days as well, talking to Congress. A lot of investors took his comments to be quite dovish. Would you agree?
Yeah, I think so. And I think he's really left the door open to a September rate cut, which was perhaps, in question. But I think he's trying to tilt the market towards what we're seriously looking at that as the month to potentially start the rate cutting cycle. Of course, dependent on the data. But again, today we've got another benign set of CPI data, which will push in that direction.
Well, next week, the big event is in China. It's the third plenum. What measures are you hoping to hear there in terms of trying to boost the world's second biggest economy, which, let's be honest, hasn't had a great 2024?
It has had some challenges, and the third plenum is traditionally one where the Chinese authorities announce some reforms and long-lasting reforms. So it's hard to know what will come out of that. I suspect that we'll get a lot of focus on green energy industries as well as technology, so AI and the like. So I'd expect general sort of support for solar for EVs, for batteries, for AI. But I think it will be also interesting to see whether they do anything in terms of fiscal reform, but also sort of structural reform in terms of supporting consumer spending. Because the big long-term challenge for China is switching away from an investment-driven model to a consumption-driven model and putting in place social safety nets so precautionary savings can come down and consumption can come up would be a great win. Whether it'll happen at the third plenum next week remains to be seen, but I think that is the policy direction that China needs to go. My last point would be, I think China in the near term is kind of policy constrained in terms of the support it can provide in terms of direct fiscal stimulus or indeed interest rate cuts, and that really means that the economy is continuing to struggle under the dead weight of the housing market, and I don't think we'll see a material pickup in domestic demand this year.
Daniel McCormack from Macquarie Asset Management, many thanks for your thoughts.
Thank you.
And that is Market Insight. Don't forget you can watch more videos on Reuters.com.